Hello guys, welcome to my channel. Today I want to introduce you to the classical head and shoulders pattern and inverse head and shoulder patterns. So head and shoulder pattern starts with a rally, which after that a peak is formed and price retraces back to find support. After that, price rally up to form another peak, which is the head. It retraces again to find a support. After that, it rallies up and form another lower peak again, which is the second part of the shoulder before price heads down. Another part I'll be talking about later on in the video is the inverse head and shoulder. It forms after a bearish move. After that, price finds support and retraces back. Then it forms a resistance and you see price coming down to form another dip. After that, price retraces back to find a resistance again before coming down to form another lower support before going all the way to this point. When you are trading the head and the shoulders, if you have a slant slope, it is much more promising because the possibility of price coming all the way and for you to make a profit is high. And when you have this slant slope again in the inverse form, it is much more better than when the slope is somehow like this. When it is here, you know that price has broken the previous resistance here and a new resistance has been formed. So it's much more better. Same way here, if it is here, you know that price has broken this previous support here, and this support is now what we are looking at. So after this support is broken, price goes on to form a higher high. After that, it's a wash through. So this is a reversal pattern. It's a classic one, and it will surprise you how many people are still trading this setup. So let us go in so that I can show you an example from the chart. As you can see from this chart, you can see this extended rally up here, and after that, price formed a resistance here. You can see it retraces back and made a much more higher move and form another resistance which is higher than this resistance. It retraces back again, moved higher and formed another resistance which is higher, which is lower than this. So if you bring out our tool, we can draw from here to here, which is the first point. Trace back the retracement and go back to this point, then come back to this point and draw this. So you can see this is a head and shoulder pattern. So we have the first shoulder, the second shoulder, and we have the head. So this is our neckline, and it is expected that we buy after this neckline is broken. For your trade to be profitable, you have to buy when this neckline is broken. Like I said previously, it is good if you can have this to be sloping this way, because this is a bearish trade. If it slopes this way, your chances of having a profitable trade is higher than when it is this way. But it doesn't mean when it slopes this way, it won't be profitable. So if we are entering this trade, we enter around this zone. So we have to wait for a confirmation. We have to wait for a breakout, a bearish breakout of this pattern before we can say, yes, this pattern has been confirmed. So we wait for the next candle. The next candle gave us a bullish candle close. We'll keep waiting until there is a confirmation. No need for rushing this. So you can see price has come to test the neckline, but it hasn't broken it yet. So we can say, okay, so now we have a candle that have broken the neckline. So the best place for us to enter is still around here. Before this candle closes, we would have entered around here. So let's see. After that, what we have. So you can see. So price came all the way down. See? After the entry here, you see price came down here, retraces and came back to test the entry point, which is the neckline. So if someone failed to enter here and the person entered at this point, would have still been a great trade, because after this, price came all the way to test where we ought to put our target. So if we are entering this kind of a trade, we enter at the neckline, we enter here, then our target is here, which is equal to the other side of the shoulder. So our stop loss will just be above here, so that we can have a proper risk to reward ratio. So we can just put our stop loss somewhere around here, because if we decide to put it above here, then the risk to reward ratio will not be that proper. So after the entry, how do you get your target? Is you measure from here to here, and you measure the same distance down to this point. That is how you get your target. So another one I want us to look at is the inverted head and shoulders. After this sustained bearish move, price came here, found support, rallied up, and price came down all the way to this place, formed another support before heading up here, and now price has come here, and possibly there could be another support that could be formed here. So if we have this looks like this is the potential inverse head and shoulder. So this is the potential inverse head and shoulders. And like I said previously, this, you can see the neckline formed an ascending slope. So it's giving us a bullish vibe. So this is much more promising than the previous example. So this is our first shoulder, the head, and this is the second shoulder. So for us to buy this trade, we need to wait for a confirmation. And how do we get that confirmation? It's until price close above this neckline. That is when we can take off going bullish. So we have to wait for a confirmation before we go. The next candle close give us exactly that. You can see how healthy the candle is. So our next move is to look for opportunity within this zone to buy. So after that, see the next candle. You see, the next candle gave us the opportunity. It came and retested the neckline. So this is where our entry ought to be. And considering how things are now, our stop loss may be beneath this shoulder. Then our target will be equal to this place. So to get our target, we measure from here to here. Then that equal distance will now extend it to this place to get our target. So if we enter here and see, price still gave us another opportunity by coming down here to break through the neckline, but closing above it. So this is another opportunity for us to enter this trade. Then after that, what we have, you can see much more. You can see the price has been offered to us much more cheaper than how it was before. So if we do not enter here and we saw this pattern at this point, then this is the best place for us to enter this place, because it has been offered much more cheaper. If you buy here, your stop will be here, and your target is here, your risk to reward ratio becomes much more higher. So we have this, and see how price is going. Price, yes, and see price kept on going. You can see gradually, see our target finally gets hit. So this is how you trade the head and the shoulder pattern. Let's say if our stop loss is here and our entry is here, and we have our target here, you can see this is like almost, this is our risk and this is our reward, which is like almost 1:2. Please don't forget to give this video a thumbs up. If you don't already have, please subscribe to this channel and turn on notification. Thanks for watching. See you in the next video.